Yes. Hello everyone. Okay. So we are on chapter number 2, starting with the second concept, that is the viewpoint analysis. Okay. Yesterday we have completed the scorecard concept of chapter number 2, and today we're going to start with the viewpoint analysis. Okay. Well, let's start now. So the viewpoint analysis, one word which we are supposed to remember, viewpoint analysis focuses more on the profit aspect of the company. Okay. It focuses on the fact that on what basis can we compute how much return are we getting. Okay. So one thing we can say that the profit can always be computed in terms of the sales which we have done during the year. Okay. Or we can also compute it on the basis of the assets a company has. Now what relation does the asset and profit have? How much money we have put into purchasing of assets, right? Like the machines which we have purchased, and how much production it is giving us, and on that basis, how much profit is being earned. Or we can also compute it on the basis of the complete valuation of the stock. So profit is being one of the most important factors of performance management. We are into the heading, what are the tools which can be used for measuring performance management, correct? So Duo Point says that profitability is one of the most important concepts on the basis of which performance management of a company can be measured. And profitability can be measured in terms of three things. It can be measured in terms of sales, it can be measured in terms of the assets the company has, and it can be measured in terms of the valuation of the firm. Okay, we will get into details what ratio it has in terms of sales, what ratio it has in terms of assets, and what ratio it has in terms of the valuation of the firm. And so it says that profitability is one of the most important measures in performance management. Okay, through several developments emerged in the arena of profitability analysis. Okay, nowadays there are multiple types of the profits that can be computed, such as the social profitability, triple bottom line approach. Okay, we will get into this. The basic premise of profitability will always remain same. Okay, so profitability of an entity can be measured in relation to sales, that is expression in terms of sales, in relation to firms investment. In firms investment means how much money we have invested and how much return are we generating from it. And then comes is the valuation of the firm, because if it's an equity based company, the profit will play a very important role for the equity stakeholder. Thus, all the aspects of profitability discussed above, that is the profit, that is the investment, and that is the valuation of the firm, are covered in analysis of the financial ratio. So, our today's discussion will be a little bit of a practical discussion and not a complete discussion. And thus, here the duo point analysis is an extension of analysis of the profitability. A very important point here. क्लियर? यहाँ पे क्या लिखा है? 10 duo point analysis करता क्या है? Duo point analysis is an profitability analysis is being done since ages. All the traditional methods of computation of ratios include profitability, but duo point analysis does it in a different form, and therefore it is said to be an extension of analysis. One of the most popular ratio under the category is the B1, that is the investment, is the return on investment. Correct? But return on investment is considered as a mixed ratio, because in return of investment हम लोग क्या compare करते हैं? Investment and profit. Investment is a balance sheet figure and profit is a income statement figure. And that is why it is said to be what? It is said to be a mixed ratio, as it relates to profit, which is income statement figure, and investment, which is the balance sheet figure. So they are considered, which are as follows, that is the return on assets and return on equity. Fine. So let's start with the first concept of return on assets. Okay, now return on assets formula will be what? The formula will be net profit, correct? Whatever is the company's return basically, which is divided by the average total assets. Correct? Now, net profit What does an average total asset mean? That is the opening asset plus closing asset basically divided by the. Is this clear? Now, thus, what do you mean by the word total asset? Now, this total asset which we have purchased in a company, okay, now this figure, okay, this figure, that is whatever asset we have purchased, that money might have come via equity, if it's possible. It might have come via any other obligation, or this money might have come via debt. Is this possible? So they are telling whatever assets a company purchases, it will need cash for that, and the money comes from equity, debt, loan, or any other form of the debt. And here the net profit figure is going to be EBIT after tax. After payment of taxes, whatever the remaining balance will be in the EBIT, that will be considered as the net profit figure. So, the numerator will be EBIT 1 minus P, and the denominator will be average total asset, that is opening asset plus closing asset divided by P. Now, let's write the formula once again. Now, what analysis they have done? Dew point analysis means they are considering two formulas for this. Okay, let's write now. Return on assets. So, for example, I'll just write whatever is the return. Okay, now divided by total. Now, in Dew point, he says we can split this in this form also, that is return upon sale into sale upon total asset. Correct? That is return on asset. Return upon sale is a formula for basically margin, that is the gross profit, I think. Margin on sale. And this is a figure for total asset turnover. Okay, in Intel you might have all studied. So they are telling in Dew point analysis, as per him, return on asset is a combination of two formulas. That is the formula for margin on sale and the formula for total asset turn. This is known as the profitability ratio. That means how much profit a company is able to earn. And total asset turnover is company's activity ratio. Activity ratio मतलब होता है what level of activity a company is entering into with the help of the asset that it has purchased. So next, now, therefore, the conclusion which they give on ROAI is that the ROAI depends upon two factors. One is the profitability factor and the other one is the activity ratio. So if, for example, there is an increase in ROAI, it might be due to profitability ratio or it might be due to activity ratio. Thus, return on asset can increase due to two reasons. Either it can be because of the asset turnover ratio, the formula has been updated, or it can be because of the margin of the sale. Or if there is a decrease in ROAI, it might be due to profitability ratio or it might be due to activity ratio or both. So whenever, the basic conclusion is whenever we are doing analysis of any company ROAI, we should always take into consideration that why there is a movement in ROAI. Is it because of the gross profit or the profit and margin ratio, or is it because of the activity ratio? So this is the total discussion of ROAI. Cool? So let's go and read one. Let's read a very simple concept. Return on assets is basically a profitability ratio which provides how much profit a company is able to generate from the asset. Return on asset. Asset पे से how much profit are we able to earn? That concept is known as the ROAI. In other words, return on asset measures how efficiently a company is generating earnings. Which means what? We'll just have a look. For example, net profit is 1 lakh. Asset पे खर्चा किया 5 lakh. It means what? They are not, till now, they are not efficiently using our assets. But when your investment is of 5 lakh and you are able to earn a profit of 6 lakh over a period of time, that means what? You are able to earn good profit from the asset, which means what? You are efficiently making utilization of the asset. That is, it might be via double shift, via triple shift, or 3 runs in a day. That is efficient utilization of the company. So therefore, it is written here that the return on asset measures basically how efficiently company's management is generating earnings for the economic return. And higher the number, better the number, right? If हमारा profit 10 lakh है and asset is 5 lakh, answer is 2. It's a good thing, right? And if this goes to 20 lakh and this is yet 5 lakh, very good. So for ROAI, higher the number, which means higher the number, it means that we are using our assets more efficiently. Thus, ROAI is shown as a percentage, that is higher the number, more efficient the company's management is. And therefore, return on asset is equal to net profit upon total assets, where total assets means opening asset upon closing asset, which is divided by the. And here it is known the profit which is being considered is EBIT, that is adjusted for the tax. Clear? So that is the concept of return on asset. Okay, now what is dew point analysis? What analysis dew point is doing on this? Let's see that. That is very, very important. These are the crux of the concept. Thus, there was a company basically, Do Don't D, जिन्होंने ये concept launched किया था. Okay. Thus, the finance executive of the Do Don't of this created the dew point system, also known as the dew point model, a financial analyst. And thus, the DuPont Corporation pioneered the system of financial analysis. The DuPont model is an extended analysis of the profitability. But what does the DuPont analysis do? So they have taken one analysis they have done is where they considered 3 factors together. हमने अभी जो पढ़ा, there were only 2 factors. There was one profitability ratio and there was one activity ratio. But DuPont analysis says I have done 2 types of analysis, where one is a 3-component analysis and the second one is the 5-component analysis. Okay, now let's start. As such, the introductory level, we have done this. Return on assets is the multiplicative factors of 2 ratios as discussed, namely the profit margin ratio and secondly the asset turnover ratio. And thus the same, thus the return is equal to this and clear. Very, very easy. But let's go through it once completely so that all our concepts are clear. Thus, return on asset measures the synthesis of 2 ratios. One is the profitability ratio and other is the activity ratio. Thus, the ROAI can be improved by enhancing either. This is a very deep analysis. That our ROAI will depend upon 2 things. That will be the profitability ratio as well as the activity ratio, or it might be the combination of both. So sometimes what happens, the return on asset can be same for 2 types of companies. Okay, for example, a grocery store. Okay, for example, एक दुकानदार जिसका profit margin will be low, but asset turnover ratio will be high. Okay, a retail store, if you go to a retail store, the profit margins are very low. They earn 2%, 3%, 3.5%. That is the profit margin. But their asset turnover, they have just invested in one asset, that is a shop. And in that shop of, for example, 5 lakh, they are selling material of 20 lakh. And therefore, the asset turnover ratio is very high for a grocery store. But same, if we take into example a jeweler whose profit margin is very high, but it might have a low turnover rate. Expenses on assets is very high for a jewelry. But their answer for both will be 25. Means the return on asset figure for both will be what? For both will be 25. Because therefore they are telling this ratio depends upon 2 factors. So whenever we see the ROAI, we should go into the detail and check what is the asset turnover ratio and what is the profit margin ratio. And accordingly, we should take the ratio. And that is why here it is written that the grocery store they having this and here your return on asset concept comes into it. And they have done little more deep analysis where they tell The two-tier approach is the primary approach to analysis. This is one of the most basic approach which needs to be done. But they tell for the purpose of any time, whenever we compute return, we should also take into consideration return on equity. What we should take into consideration? Return on equity. Why this new concept have come into consideration? Because they say that Viewpoint wants to tell us there might be three components or five components. So for the purpose of understanding the three component analysis, now we have understood the two component analysis on ROE. Now we are going to understand the three component analysis on which factor? On the factor of return on equity. Return on equity means what? Return on owner's equity. It will be what? It will be the rate of return earned on by the equity shareholder. What amount of return a equity owner is earning is known as the ROE. Okay, let's just place out here one so that it's clear. Come, let's see. So now we are going to consider return on, correct? Now, what is return on equity? It's return on assets into equity multiplier. What does the equity multiplier mean? Anyone? It is total assets upon equity share capital. Correct? Now let's analyze this. Okay, now sometimes it might happen that the total assets in a company are 2 lakh and the equity share capital is also 2 lakh. So your answer will be what? Your answer will come 1. 1 means what? The company is an all equity company. It means that the company does not have any debt. So here we can conclude if the answer is 1, it's an all equity company, it means the risk of debt is less. Right? So this is the meaning of what? Equity multiplier. Okay, ऐसा भी हो सकता है एसेट 5 लाख के है बट इक्विटी शेयर कैपिटल कितने का है? इक्विटी शेयर कैपिटल, your answer will be 2. It will be a bigger number. Even though it's a bigger number, but when we analyze it, bigger number means what? There is a more risk of debt in the company. So sometimes what happens for C. For example, this was 100 into 1. The answer will come what? 100. And for example, 100 into 2. The answer will come. So your return on equity will increase. So only if we look at the increase, we feel wow, the return on equity is increasing. But along with an increase, there is one factor, that is the equity multiplier, which has increased your risk because there has been more debt instruments in the company. So this is one of the deep analysis that whenever we consider ROE, always go and check that if last year it was 100 and this year it is 200, go deep and just check whether it is because of the debt factor or in reality return on assets has increased. Clear? So this is the ROA, ROE. And sometimes ROE is equal to ROA when it is an all equity company. When will this happen? When it's an all equity company. Okay, sure. Now let's go deep and let's go into what? Let's go into the 3-point analysis. Okay, now let's. इसमें से 2-point analysis तो हमारी हो ही चुकी है. ROE. ROA, we used to consider 2 factors. One was profitability, we can say, and one was activity. Okay, I'm just giving it the name as productivity. How much productive are assets? And last, यहाँ पे क्या आ जाएगा? Then comes our equity turnover ratio. We can just say right here equity multiplier. Is this clear with everyone? This we have already studied. Okay, that is, this is the profit margin ratio, this is the asset turnover ratio, and this is the equity multiplier. Profit margin ratio will be net profit upon sale. Asset turnover ratio will be sales upon total assets. Equity multiplier will be asset upon shareholders equity, we can write, or equity share capital is also fine. always remember, asset जब आप खरीदते हो, you need money, and that money will come from where? That money will come from debt plus asset. Is this clear? So if, just for understanding, I'm just telling here, if your equity multiplier answer is 3, it means what? Asset upon shareholder. It means 3 times your of shareholder equity is your total. It means what? In our company, हमारा इक्विटी 100 का है और हमारा एसेट 300 का है, मतलब 3 टाइम्स इक्विटी है। मतलब बचा कुचा पैसा फिर आया कहाँ से? बचा कुचा पैसा है कम फ्रॉम दी। That is the meaning of what? That is the meaning of the equity multiplier. So whenever, basically, what does this analysis mean? That whenever we study ROE, and if there is an increase of 10% to 12%, for example, in ROE, just don't go blind for that equity का return बढ़ गया. There will be any of the 3 factors जो increase हो. There might be an increase in the profitability. There might be an increase of productivity. यहाँ पे problem नहीं. But if there is an increase in equity multiplier, मतलब ये भी 1 था, ये 1 था, ये 1 था, अब क्या हो गया? ये 2 हो गया. बट इसका 2 होने का रीजन क्या है? इसका 2 होने का रीजन है कि कंपनी में डेप्थ इंक्रीज हो गया, कंपनी में रिस्क इंक्रीज हो गया. So we need to check that this increase is because of what? Is it a good impact or it's a bad impact? Is it because of the profitability or is it because of productivity or is it because of the equity multiplier? It needs to be considered. Okay, so let's go to the module and let's go and have one analysis. Does the 3-point analysis is the same. They have considered that there are 3 factors. The first factor is the profitability, that is the net margin in a company, which is reflected for every rupee of sales affected by the company. Right? What does the profitability ratio mean? The profitability ratio means how much money we are earning on every rupee of sales. What is productivity? How much company is able to generate profit margin from the assets utilized. That is how efficiently company is using its assets. And the last point is the equity multiplier. But in equity multiplier, there is one secret point, that equity multiplier increases if there is an increase in the debt component. That is if there is an increase in the risk component in the company. And again, they have written the same thing. See, first is the margin on sale ratio, second is the asset turnover ratio, equity multiplier ratio, or combination of it. Means that ROE में अगर movement होगी, if there is a movement, there might be only one factor. It might be only because of margin on sale. It might be only because of asset turnover, only because of equity multiplier, or it might be a combination of all. So let's go to the example and let's study the case 1. Okay, a very important thing, paper में case आएगा and then you need to give them what is the reason of increase or why both the ratios are same. Okay, let's start. So what is the example? Mrs. Q is an investor who has decided to invest money in the business either of retailer A or of retailer B. I want to make an investment either in company A or in company B. She researches their financial numbers and finds that the return on equity of both is same at 45%. But always remember, even though it is same at 45%, decision nahi lena hai. We need to look at why it is 45%. Profitability के वजह से है, productivity के वजह से है, या it is because of the equity component. Okay. Thus she decides to look further and find the following data, where it can be seen that retailers A profit margin is 30, asset turnover is 0.50 and equity is 3. While the same figure, okay, I'll just write it down, that the profit margin is 30, asset turnover is 0.50 and equity multiplier is 3 for A. And for retailer B, the profit margin is 15%, the asset turnover is 3 and the equity multiplier is 1. So how are we going to decide which company is a better company? So our analysis will be ratio wise. If we consider the profit margin ratio, the profitability margin ratio of A is better. If we look into the asset turnover, the asset utilization of B is better. है ना? 3 आंसर आया, इसका मतलब क्या है बच्चों? प्रॉफिट 6 लाख है, एसेट 2 लाख है, देन आपका आंसर 3 लाख आएगा. But if you have assets of only 2 lakhs, but you are making a sales of how much? 6 lakhs, it means you are doing an efficient utilization. So B is having better utilization of assets. तो एक में A अच्छा है, एक में B अच्छा है. Now यहाँ 3 का मतलब होता है there is a huge amount of debt company. 3 times the equity is your debt. And 1 time means what? It's an all equity company. And thus accordingly anyone can decide. The people who want to take higher risk can invest in retailer A. Who wants to take a moderate risk can invest in B. Okay? Let's read what conclusion they have given. Let's start. Thus retailer A business is more profitable. Correct? And retailer B is able to utilize more as compared. The equity multiplier of retailer B is 1, implying that it is an all equity firm. Thus, it may be inferred that the financial risk here is 0. क्योंकि all equity company है, risk becomes 0. But for the retailer B, it is 3 times the shareholder. And thus, these are the 3 components which are to be considered in the viewpoint analysis. 3 components. And therefore, the analysis presents the 3 components of viewpoint analysis may not suffice the financial information needed, but provides her with the analytical information. Okay? See, viewpoint analysis means this is the only data required for a company, ऐसा नहीं. Okay, this is only the data required for a company, answer ऐसा नहीं. But this is a concept which is used more for what? Analysis. Financial analysis of the information. That's it. So whenever if you are required to do any form of profitability analysis, you can use which concept? You can use the viewpoint 3 component. Okay, now let's go to the case 2. Again, a very simple concept. Let's just read. Let's go. Now, here also the return on equity, there are 2 companies. Okay, one company is company Lotus, yes, and other company is ASS. अब कंपनी लोटस में भी 50% to 60% हुआ है रिटर्न ऑन इक्विटी. तो गुड. बट नाउ वी नीड टू गो इनटू द डीप एनालिसिस. ये हुआ किस वजह से है? ओके, लेट्स एनालाइज. ओके, नेट इनकम. ओके, इनकम इज इंक्रीज्ड बाय 200. रेवेन्यू रिमेन्स सेम. ओके, सो दे हैव कैलकुलेटेड द प्रॉफिट. नाउ रेवेन्यू फ्रॉम ऑपरेशंस रिमेन्स सेम एंड देयर हैज बीन अ डिक्रीज इन द. क्या हुआ इस कंपनी में? एवरेज एसेट्स ऑफ द कंपनी हैव गॉन डाउन, बट इट्स अ गुड थिंग. इवन तो उनका एसेट कम हुआ है, 5000 से 4800 हुआ है, बट इफ यू लुक एट द रेवेन्यू इट रिमेन्स. इफ यू सी, इवन दिस इज अ गुड and even this is a good. Correct? You are able to sell the same quantity even with a reduction in the asset. And the third ratio, okay, it's same. The average assets have reduced, but the equity remains same, and therefore there has been here a reduction. So ideally, if you see यहाँ पे there is a reduction, and reduction is also a good thing, बच्चे. Right? It means यहाँ पे risk कम हो रहा है इस पर. So now, what is the reason of ROE increasing? The only major reason for ROE increase here is increase in the net income. See this factor. If you look properly, it is this. Plus assets have reduced. So these 2 things are a good thing, and therefore it's a good thing. But if you look at the next company. In ASA, what is happening? Let's see. Okay, the net income remains same, the revenue remains same, the ratio for this remains same, the asset turnover remains same. Okay, it means there is an increase only in the equity multiplier. But one problem with the equity multiplier is that whenever there is an increase in equity multiplier, it means there is an increase in the debt component, it means there is an increase in the risk component. So even though there is a very big jump, we should not go by the face. but go and look what is happening in the company. And thus, if you see the ASA company is what it may be observed that the profit margin and the asset turnover ratio remains same. But ROE has significantly risen from 42% to 60%, but only because of the equity multiplier. Correct? And the investor is concerned because additional borrowing has increased ROE. It means company ने क्या किया है? Company has taken more debt. But if company has taken more debt, there has been no movement in the assets and no movement in the sale. This is not a good thing. If you go up, okay, company has done borrowing, that is fine. Even if the company has done borrowing, but what has the company done with the borrowing? The assets remain same and the profit margin remains same. It means it is not a good scenario. But actually it didn't change the company's net income, nor the revenue, nor the profit margin, which means high financial leverage makes the firm more lucrative but fails to create actual value. It means even though the loan has been taken and upper say the picture of the company has increased, that the ROE has increased, but in reality it has not. But same if you take for the Lotus, there it is a good thing. Okay, it has also inferred that there is a partial reduction in debt since the total asset has declined while the equity remains constant. So Lotus is performing better as compared to the AS. So this is the Viewpoint analysis of the three components. And here the major part of the three component analysis is complete. Okay, let's just summarize this factor. Thus the three components of the Viewpoint analysis are that the Viewpoint analysis is a model created by the Viewpoint Corporation and is used to analyze the fundamental financial performance, that is the profit. Okay, Viewpoint, there is only one basic. It wants to compute what? It wants to compute the basics, that is the financial ratio. It is a three variable framework, that is the net profit margin, the asset turnover ratio and the equity multiplier. Usually, whatever will be your results will be always expressed in the form of percentage because it is return on equity, which will be always 10%, 20% or 40%. Viewpoint analysis dissect all these factors. Dissect का मतलब क्या होता है? ROE को break करता है तीन पार्ट में और तीनों पार्ट को डिटेल में एनालाइज करता है. One of the major advantages of Viewpoint framework is that it encompasses equity multiplier, which is a measure of the leverage. Leverage means पैसा कहाँ से आ रहा है. In the measurement of profitability, which is an operational ratio. The profitability, if you consider, is an operational ratio. It's an income statement ratio. But हम यहाँ पे कौन सा factor consider कर रहे हैं? Then also in this formula, we are considering the equity ratio, equity multiplier ratio, which is a financial leverage ratio. कि कंपनी का कितना leverage debt के ऊपर, which is a very important thing. So this is the summary of Viewpoint analysis. सबसे पहले it is used for analyzing the profitability, considering the three facts, always expressed in the form of percentage, dissecting the ROE into three parts, and one of the major important thing is not profitability and activity ratio, is that it is considering equity multiplier is one of the major highlights of the Viewpoint. And thus we complete here introduction of the Viewpoint analysis, and there are 2 points of Viewpoint analysis. One was the three segments and the other one was the 5 component analysis. So today we have completed this part, that is the 3 component analysis. So ideally we started with the 2 component, that is return on asset. Then Viewpoint में बोला कि नहीं ROE करो, इसके अंदर ROA भी आता है प्लस इक्विटी मल्टीप्लायर भी आता है. So they added it here and they had a 3 component analysis. And then they said no, profitability has to be discussed in very detail because it is one of the most important factors for performance management, and therefore we came up with the 5 component analysis. Okay, so the 5 component analysis we will complete tomorrow. Okay, this is for today. Okay, thank you.